In today's video, we are going to answer a product question with respect to whole life insurance policies set up for maximum cash value. The specific question had to do with the product, a paid up at age 65 policy or a whole life 65 policy. What type of product is this? How does it work? Do I have to pay into it up until the age of 65? We're going to provide a breakdown. So a whole life 65 product is a somewhat popular product that exists. And in short, what it means is if I see a policy called paid up at age 65, whole life 65, some companies might call it life 65 or L65, it means that the premiums are due, guess what? Up until your age of 65. So the individual that asked about this started his policy at age 27. So what that means, if he looks at his contract language, is that his premium, it's just about $12,000 per year. It's a little bit less. That premium payment is due from age 27. That's when the first payment is due every year up until age 65. Now here's my follow-up question. If this is you, does that mean that you must pay that premium up until age 65? And if you don't make the payment, the policy can lapse and you'll lose everything? No. It is possible that the policy could lapse. It is possible that you could lose everything, but that has to be a pretty drastic situation. For example, I'd have to have a 100% base premium policy and I stop making payments after the first or second year. There's ways you can easily stop paying early. So to provide some information on this, paid up at 65 means that the premiums are due up until age 65. He started at 27. What if he doesn't want to pay into the policy that long? Does he have options? The answer is yes. He can stop much earlier than that. One, if he wants to stop earlier, because a lot of times people do, we can exercise this option. Once he's built up a decent amount of cash value, when I say decent amount, enough where it can easily support the $12,000 premium. And what this option is, this premium offset, is this allows for the dividends and interest that are being generated in the policy to pay his premium for him. So this way, his out-of-pocket commitment is zero. The earnings in the policy first support the premium, and then everything left over will be kicked back into cash value. So this is one option to be aware of. Now, we do have to always look at this option and examine it with the company's present dividend interest rate. Because if I have a situation where I want to do this 3 or 4 years into the policy and I haven't added much into PUAs, it's not a policy that's set up for high cash value, it'll be a case where a premium offset might not work. And the illustration will tell you that. It's good to look at this based on the present dividend rate and also the guarantees, but the illustration will tell you if a premium offset will work. How you can tell is if your out-of-pocket is zero, that means it worked. If it's calling for money, meaning that illustration is saying you need to pay this premium or a partial premium, that means there's not enough cash value, there's not enough earnings being generated in the policy to support that premium for you. Another option, if he wants to stop early, is called a reduced paid up option, RPU. A reduced paid up option will eliminate the premium altogether. So with that option, we do forfeit the right to make premium payments. So that's not always an option people are interested in. If someone has a lump sum of money and they want to fund a product for a short period of time, that's a very attractive option to be aware of. We've seen a lot of people like that. But my point is here, we do forfeit the right to add premium payments, but by eliminating the premium, what happens is all of our dividends and interest now do not need to support a premium. They can be kicked back into our cash value. We can often see stronger growth, especially when we look at the guarantees, but there's some other things to be aware of with that. In most cases, when you exercise a reduced paid up option, your death benefit's going to drop. And the reason why is because how a reduced paid up works, the insurance company is going to say, what's your current cash value? And based on that cash value and your present age, if you elect this reduced paid up, here's how much life insurance you'll have that's guaranteed to be paid up. When I say paid up, there's no recurring premiums. You're guaranteed to have this death benefit, and if you receive dividends, the cash value and death benefit will appreciate over time. But it is a nice option to be aware of to stop payments early if he says, hey, when I started this, I didn't really want to fund it for a long time up until age 65. I like the idea of going aggressive maybe for 10, 15, or 20 years and then stopping or something like that. Everyone's different regarding the funding period. With that reduced paid up option, we typically cannot do it earlier than the 8th year. That has to do with the initial seven years on a policy and the MEC test, so we do need to be aware of that. But the main question here, with that paid up at 65, do I have to pay up until age 65? The answer is no. The premiums are due until 65, but you do not have to pay into it that long. To illustrate, actually, let's look at a quick example. Let's look at this. So we can look at a paid up at 95. So an L95, guess what that 95 represents? With the L65, the 65 represented 65 years old. So with the L95, guess what? Age 95. So if you take out one of these policies, how long is the premium due for when you read the actual contract language? Up until the age of 95. Must you pay into it that long? No, you do not, if we do things properly. So here's a quick example. Here is a 40-year-old male. Let's look at the actual illustration here. This will be better. So we've got the guaranteed values and such, but let's take a look at this. Whole life 95, 40-year-old male. I'm going to scroll down actually, because if we just run a basic illustration, the premium will be due forever. Forever. However, we're not paying it forever in this case. So here's a policy where I can make premium payments up until 95. My actual premium payment is $9,000 and change. However, we've got this policy designed for high cash value. He's plugging away $100 grand per year. He does that until he gets a total of $500,000 into the policy. So there's your annual payments. There's your total payments, $500K. Here's your net cash value. Look at that. By year 5, you've paid in $500. You've got about $520. It's based on the present dividend rate. But look at this. Year 6, you pay in 0. So you have a whole life 95 policy where if we look at the contract language, contractually that premium is due up until age 95. So what we did here in year 6 was exercise that PO, which is premium offset. So over here, you can see the premium that's still due, but you're not paying it. The policy is paying for itself through dividends and interest. And then in year 8, look at this, that reduced paid up was exercised, which eliminates the premium altogether. We do see a death benefit drop as a result. If we had less cash value in here because we funded less, when we exercise that reduced paid up, you would see that death benefit even lower. But before we actually make these changes with the policy, it is something we can forecast, meaning we would look at an in-force illustration to see exactly what things would look like. Purpose of this illustration is you can see what things potentially look like when we are creative. So we've got a policy where we're not going to pay into it forever. And what's very valuable to look at are all assumptions. So here's the same thing, but based on the guarantees. My break-even point, right? Instead of years 3 and 4, now it's between years 6 and 7. A lot of additional information to answer the question, do I have to pay up until the age of 65? No, the policy design and such and different levers I pull will play a role. It'll have an impact. But as long as you or your agent is aware of the different options and set your policy up correctly, you'll be in a good position where you can really maximize the cash value and use the policy over time. And I'll end with this. Let's say you went with this L95, or even if this was an L65, and you did exactly what we just saw, meaning over the first 5 years, you paid in a total of $500K. That illustration we just saw, what happened in year 6? You paid in nothing. However, if you said in year 6, I want to keep funding it, maybe not the $100,000 per year, but I just want to pay the premium. Let's say I round up to $10,000 per year. In that example we had up, can I do that? The answer is yes. And you can actually do it age 65 if it's the L95 policy up until 95. However long that premiums can be paid contractually, you could continue to add funds to the policy that long if you wanted to. So I hope you enjoyed this video. Let us know if you have any questions or comments. Please leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.